Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name is Seth Cressman, joined here again, Ben Brayshaw and Dan Mickelin. How are you guys doing today?
I'm doing good, Seth. Good day. Beautiful out. Nice weather. Looking forward to talking about portfolios, talk about investments, get some real roll on helping people move forward in their investment strategies.
Yeah, you know, school's almost out for kids, but school's in for you guys and listening to this to learn how to get invested and design that portfolio.
Hey, if you're new to Money on Tap and you're reaching us on the radio, thank you for being here with us today. We're going to have some fun. First of all, we're three financial planners that, you know what, for fun, once a week we get together and we do a podcast and a radio show. And what we're going to be covering today is Portfolio Powerhouse, from beginner foundations to winning strategies. This is not a DIY show, if that's what you're looking for. But that doesn't mean that you can't take what we're talking about and turn it into a DIY. So it's going to be a lot of fun. We spend a lot of our time as financial planners inside of portfolios and designing them and really creating options for our clients that are accomplishing specific goals. And there's nothing new about that, right? But, besides that, we do focus on a lot of other aspects in financial planning at Money on Tap. And so if you're unfamiliar, check us out on our podcast, go back, look for whatever show topic really kind of suits what you're looking for today. Grab and go. It's a place where you just get to dive in with us, have some fun. And, there's certainly parts of this that are very DIY. We're very focused on, creating and keeping wealth. It's at the passion and the heart of our practices. And so to be able to share that with you, yes, what a gift. And it's going to be great. So you have a show name for you, what we're going to be talking about. You know what? We usually like to take a couple of minutes and check in and say, hey, how's the weather? Is it good? Are our sails full? Are we ready to get this ship going?
Seth, I'm excited about a couple parts specifically in this show. I'm excited to talk to people about, all the different ways of investing and building a portfolio. And honestly, things that we've used, in different times of, the time period of managing money and managing portfolios, things that work during different cycles versus others. I think we're probably one of a very few number of managers that move in and out of, passive investing and active investing for clients. We use a lot of, fundamental trading processes as well at times. I mean, like what's really dynamic about our portfolios is that they are constantly evolving based on lots of history, lots of things that we have tested to see if they work. And, we've really seen some value from that is, spoken to our clients in ways. But diversified portfolios themselves are very complex beasts. I mean, they really are. They're a beast because, they have so many moving parts and the market is so vast and so large. And you know what? You never know what next, meme event's going to happen out there on the internet that's going to send chaos or craziness, or what political or, military event globally will affect things. And so there's lots of moving parts inside this beast that I'm happy to really, chat about today with you guys and kind of, have this roundtable approach on things that we've done and pros and cons of that stuff.
Well, all right. There you have it. Before we get into the Portfolio Powerhouse episode of Money on Tap, that's right. It's time for Money in the News.
Today from CEN and Matt Egan, CEOs are making almost 200 times what workers are. And this is a topic that's, come up before, and, it's something that I read regularly, around this time of year as these things start coming out, that generally infuriates people. It's a topic that's easy to get upset about when you think of the wide disparity between CEOs and what the average worker makes. And this is all information that's disclosed by these S&P 500 companies, so some of the largest companies in our economy. And the story there, it's always been a large multiple in terms of what the average salaried worker makes versus the CEO. But what this article points to is that gap is actually widening. And that's a trend that is something that, can really upset people significantly. What they're saying is that the average or the median compensation for CEOs in the S&P 500 soared to $16.3 million in 2023, which was an increase of 12.6%, whereas the average worker median income was $81,467, which was also up, but only 5.2%. So the gap between the salaries of your median workforce employee and the CEO is continuing to spread. Now, CEO compensation is not only made up of dollars and cents in your paycheck, like would apply to most of those workers. There's often a stock element, a stock reward that's tied to that compensation. And generally speaking, it's going to have to do with how the stock performed in that given year. So it's not as simple a comparison as you might expect it to be. But the fact of the matter is that gap is widening.
Dan, I think you bring up a really good point, and something that I like to educate investors on is that CEOs will do things that might not be sometimes in the best long-term interest of a company, just to get short-term performance with stocks, because, board chairs are pushing on, CEOs and executives all the time because they want their stock values to continue to rise. They want investors to be there. They want the company to be healthy. And those are things that we see happen. And what ends up happening is good, strong companies end up seeing large downsides eventually long-term when they don't, deal with, those bigger issues or profitability issues and so forth. And that gets them trapped. So we see like really profitable companies, we see their stock drop to 5-year lows. And you're like, well, why is that happening? The market's doing well. This is happening. It's like, well, they didn't deal with, long-term issues way back when. Then they fire that CEO, bring in a new one, and he's got this pay scale raise. So, CEOs are very much incentivized to see stocks rise, which makes sense in the general overall picture of things, which I appreciate and value. But what I do think is funny is the article goes on to talk about Tim Cook, the CEO of Apple. And I was surprised, Dan, to see that he's the third highest paid CEO on the S&P 500. He's getting $63.2 million last year, which is 672 times the median of an Apple employee, which is paid $94,118. Now, the first thing that went to my head is if you work for Apple and you make less than $94,000, go ask for a raise. Right? It's 672. It's so far beyond this, 200 times issue. It's like, 3x that plus. So I think it's kind of funny, but I don't know. I really thought it was, I thought Tim Cook was kind of underpaid comparatively, seeing that how big Apple is and what they're doing cash wise, but it is what it is. Maybe just the stock didn't do well in that one quarter.
Yeah, it's fun to have lots of opinions about this. It really is, at the end of the day, it's the ultimate pay per performance, if I can get that out, model. Really, when your income is pretty much tied to the stock price, and that's what it's going to be. There's a lot of motivation to get that performance out of a company. Those things said, I don't think anybody can take a look at these numbers and ever say that there's any fair or equitable way to break this down. And I get it. I don't blame people for wanting to be paid more when they're looking at a difference of what the top dog at the company's getting versus what they're getting. And some of the other ways they highlighted here that those differentiators become even more stark is when you have companies like Ross Retail Stores. Let's see, Barbara Rentler, the CEO, received $18.1 million in total compensation last year. But the difference between what she's getting and their average, which happens to be part-time hourly retail associates, made around $8,600 for the year. 2,100 times as much as the median employee. So any way that you look at these numbers, it's sad. But we gotta go because there's more money in the news. You guys, GameStop. All right, we haven't been here or stopped here for a minute. GameStop shares are up 68% this year, but getting rich trading simply isn't going to happen, says financial psychologist. I don't know the last time. Oh, yes, thank you, Ryan Ermy. I don't remember the last time I saw a psychologist or financial psychologist in the title here. But if you're not familiar with GameStop and why we're kind of tracking this, is it was the ultimate of meme stocks, where the meme happened, social media happened, and people jumped on board. And it was fascinating to watch because of the activist positions where people were, buying and driving the GameStop higher when there was, on the other side of that, some short positions in a bunch of funds out there that were shorting this stock. And it was so cool. It was so cool to be able to see how people can be really activated inside of the market and kind of giving it to the man.
I thought this was a really interesting article in a couple of ways. This guy, Keith Gill, who's, the meme author of that Reddit post back in 2021, it talks a little bit about that. His title is Roaring Kitty. Yeah, you heard me correctly. Roaring Kitty by Keith Gill. I thought it was interesting, guys, that, this post by Gill was posted on X, Twitter, essentially, not Reddit. I thought it was interesting because, Elon Musk is considers himself the ultimate free capitalist. But this guy Gill's under a lot of scrutiny because of the meme. I mean, I think it's E-Trade he's on. They've talked about, taking him off. They've talked about, potentially the SEC is going to look at this guy for, market making and stuff like that. I think they're really struggling because the guy's just saying, buy and hold. He's, and so he's trying to, theoretically put these, hedge fund, short guys out of business, trying to kill these companies that these kids love. And, as long as he's not selling at the top per se and just really buying and holding, I don't know how they can get him from making a market. I mean, it's no different than anyone else posting something, but the posts aren't really like that clear. Like you have to kind of understand the meme world to interpret this stuff. But like, I heard he posted a reverse Uno card or something like that. I mean, the guy's clever. And he's probably just staying just out of the wheelhouse of this stuff. He's probably been advised. He's worth a ton of money. But it's interesting that he's using X and not Reddit. And I just thought, guys, considering Elon Musk, and we talk about him all the time, he's probably the guy that's not going to drop him. So he's probably trying to move his followership over there. I wouldn't be surprised. Yeah,
with Reddit having recently IPO'd, I'm sure they don't want that kind of heat from the SEC or anybody else looking down their throats at the accusations against this guy of market manipulation. But, honestly, I mean, he's not an advisor. He isn't being compensated for the advice he's offering. He's a shareholder himself. He's got a $100 million portfolio in GME, from what I understand. So that's the GameStop ticker. Sorry. So I don't see what he's doing wrong. I mean, the fact of the matter that people have chosen to follow him at their own peril, which is really what I think kind of the part of the article was skipping over here a little bit, is that, this is terrible, terrible advice in a lot of ways, but, he's motivated enough people that in mass, they've been able to take down the giant, like you said, Seth. I mean, he really is sticking it to the man here in a way that has disrupted these companies or these funds. But it went up, it went down, it simmered down for a little bit, and here we are again. The thing's riding the roller coaster, and he's attracting new investors. The concern, though, the fear in that is, though, none of this change in value on a daily basis, we're talking 30, 40, 50% swings within just a couple of market trading sessions, has anything to do with the balance sheet of this company whatsoever. I mean, nothing.
Yeah, the psychologist part of this title kind of crept in there towards the end. of the article, which says, how speculation fuels investing FOMO, fear of missing out is what that stands for. And then gets into a little bit of history, which I loved, which was, what's happening with GameStop's shares now and what happened in 2021 when it just went through the roof is no different from investors in the Netherlands bidding up the price of tulips in the 1630s. So I was like, oh my gosh, we're reaching deep, deep into the investor mindset. Yeah, once the price of the stock, goes past the underlying value, eventually what happens? It comes down. And that's the fairy tale, right? We're always going to want to make sure that we give you the right information on that one. Hey, did you catch this one, you guys? Elon Musk had NVIDIA send AI chips intended for Tesla to X and XAI report. That says that thank you very much, Eric Revel. Elon Musk said that the AI chip shipment swap was because Tesla lacked space to immediately use them. I don't know. Is that, where you've got one warehouse versus another, so might as well just use the space over there?
Are they charging rent? That's my question. I really enjoy Elon Musk. I think he's tremendously entertaining. I think he's, he must be brilliant. Some of the stuff just seems crazy at first, but then it turns out to work. This whole, self-driving car thing that he wants to build, he said, hey, we're going to buy $10 billion worth of these NVIDIA chips, but then didn't buy that many because he said we haven't, no one's gotten this, self-driving system working perfectly. So, when we do, we'll be buying more. But in the meantime, we're going to store them in this warehouse because otherwise they're just going to sit idle. That's just part of the story. The real end portion of this story, and Dan and I were talking about this, earlier on, was that Musk just basically flat out says, I don't really trust the Tesla scenario I'm in. I'm not sure I really want to pour all of my AI innovation into Tesla right now. I'm not getting paid. I want my stake and I'm not willing to pour more into this thing. I think there's a lot going on here. That we talked about that Delaware court, and the lawsuit over his compensation and how wealthy he's made shareholders of Tesla. It's really interesting. And part of me kind of understands the human side of this. Like, hey guys, I can't get paid. Why would I keep pouring into a company that I can't get paid on? I generally get that, irrelevant of how much money you have. We as human people, we want to be I don't know. We want to have purpose. We want to have value. We want to see that earned. Like, we don't want to just be ignored and condemned every time. So why would I put all my effort into something that I'm not going to see those rewards? And I don't think Elon Musk is even talking about, he might be speaking about the financial compensation, but the truth is I don't really think he cares about that. It's really more of like, I want to build something and I articulate my success based on growth and income, which I've earned. So I think it's interesting to hear him just basically do it. But Danny, we were talking about this looks like and smells like a lawsuit coming.
Yeah, he certainly got a perspective on it. And, going back to that first article about CEO compensation, he's in court over a $56 billion with a B dollar payout. Big, big money. And so obviously you have shareholders on either side of that fence who think that, that's an outrageous amount versus those who say, well, he's enriched me greatly, because of the performance of Tesla. But, the performance has been waning. He's clearly distracted and got his mind into other ventures at this point. Sales in China are dipping. Sales in the U.S. are dipping. And if you're a Tesla investor, you're sitting there saying, well, more chips equals more cars, right? And all of a sudden you just diverted, five or 10, what was the purchase amount? Was it $5 or $10 billion worth of these chips to your other entities that don't benefit, my share price? I think in the heart of it, there's really an issue there. It's a one-man decision, and he's acknowledging he made that. And clearly he's, to some extent, has the discretion to do so. But if you're invested in Tesla but not in X, I can see why you have a problem with that.
I think if he can legitimately prove that it really is a storage issue, and that they're paying rent for the space or whatever, I'm sure they could get away with it. But I think it's kind of a threat is what I see it as.
Yeah, the timeliness of it really is interesting, right? If there wasn't this stock back pay scenario kind of in the headlines and all around it,
which he mentions, right?
Yeah.
He's not shy. The one thing about Elon, he is not shy. No. He is telling you what he's thinking.
No. When we come back, we are going to get into Portfolio Powerhouse. And this is from the foundations or beginnings to winning strategies. And what do we do here at Brayshaw Financial Group? Can't wait to share more with you and learn more about you. And that's when you give us a call at 855-226-8551 or info@yourmoneyontap.com. And welcome. Yeah, welcome if you're new to Money on Tap and just joining the Money on Tappers out here. And we're going to come right back with more Money on Tap. Don't go anywhere. Hey guys, Seth Cressman with Brayshaw Financial Group. Are you ready to take control of your financial future? Look no further than Brayshaw Financial Group. Our team of experienced advisors is dedicated to helping beginners like you build wealth through smart investing strategies. Visit BrayshawFinancial.com today and start your journey towards financial independence. Brayshaw Financial Group, your partner in wealth creation.
Thank you for joining us for Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's show with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap, and you can reach us at 855-226-8551 or info@yourmoneyontap.com. We are kicking off our Portfolio Powerhouse show, and this is starting off with some beginners and beginning foundations to winning strategies. And, there's a lot for us inside of the portfolio. There's a lot of different takes on this. For one, it can be very complex, and it also can be very simple. And there's all sorts of versions and variations. And for me, what's really interesting is a lot of what's behind the outcome. Why do people design a portfolio one way versus another? And how does that start to really align with, things like diversification or time horizon, all those things that are really important for most people inside of a portfolio. And when sitting down and taking a look at yourself, what are you doing? The why should and typically does wind up being very similar to the person next to us, even though we will have completely different strategies inside of those, designs. The why is we have a goal, we have a need, we have a desire, and what those things are and how they get put together ultimately is what we want to try to understand why we're going to do some specific things for ourselves inside of our portfolio. A whole lot of stuff out there to look at and sort through. But first of all, I just want to invite you to just ask yourself for a couple of questions. Well, what is it that you want? How soon do you want that? Those are the principles that we're going to start to rely on as we start to use the rest of what we're talking about today inside of the portfolio design.
Yeah, I think building a portfolio is something where it's one of those opportunities where you start at the end, right? You start out with your goals and objectives. What are you trying to accomplish? And then you work backwards from there into, well, how are we going to do that? And those next steps kind of that lead you from the end back to the beginning so you can take that step on the path is determining things like you just mentioned, Seth, well, time horizon. How long do I want to take to potentially achieve the outcome I have in mind? Your risk tolerance. How much risk am I willing to bear to get there? And then first and foremost, probably how much am I willing to put into this, that given a little bit of testing and a little bit of due diligence, a little bit of understanding about the investments I'm ultimately going to choose, is that enough to lead me down the path to the goal I have in mind? Those are, I think, some of the foundational questions, like you said, Seth, that you really need to ask yourself before you set yourself on this journey.
So I think what this show is versus what it is not is this is a conversation about how to invest, strategies around, figuring out where to put my money in this day and age, this time period, what's going on in the market, the world around us, the demographic shift that we're seeing with the baby boomers. That's what this show is about. What this show is not about is how much to invest, what this money's for, or how it gets there. But I think you guys are both making the point that you need to have all these pieces in play. This is not a financial planning show. This is an investment show. And one of the biggest problems that people have is that, they take all the information out there and they just apply it everywhere. This is not where you should put all your money, or matter of fact, even maybe a large segment of your money. It's just really a conversation about, if you're buying the stock market, how do I do that well with all that's going on? And, as you guys kind of go through these, conversations of, time horizon, risk tolerance, investment objective, and talking about those kind of three pillars of our world, of our industry, that's where, when you answer these questions, yes, my investment objective is long. Yes, my risk tolerance is higher than, a CD at the bank, and I really want to invest in the stock market. And my objective is some sort of outcome that's going to require a return that gets me to a number I need, like retirement. Then at that point in time, then we're talking about these portfolio events. And I think that's important to set the stage, guys, because, we have to get there as a yes, yes, yes to say, okay, now I need to embrace the stock market to do those or accomplish that. And I'm comfortable with that. That then leads to a number of questions and a criteria that's significantly more complex. And I hate to, kind of scare people, but as you're talking about, hey, I got all these yes answers, I'm ready to step into the stock market, and oh, wow, there's a lot of stuff I can buy. Like, I can buy stocks, I can buy bonds, I can buy mutual funds or ETFs, I can buy preferred stocks, I can buy convertible bonds, I can buy convertible ETF, I can buy convertible stock. I mean, like, there's so many different, oh, by the way, there's real estate investment trusts, and they come as stocks or they're private placements. Like, oh my word, where do I begin? There's just so much going on. And every podcast out there, every person seems to have a different opinion. What I really want to clarify for a lot of our listeners today is that I don't really care what you buy. And the reason I can say that, and the reason the three of us can say that, is because we're licensed to do business in all of these things. You meet a lot of different people and they say, only buy stocks, only buy ETFs, only buy mutual funds, only buy annuities, only buy insurance, like whatever, like, but then you start looking at where they're licensed, and then you start realizing, oh, their entire perspective is already biased on what I should do, because they've either only do business in that, or the other podcaster is like, been burned by something, or his long lost uncle, lost money in the stock market, so therefore he's only buying insurance. I mean, it's just such a joke. Every investment out there is a legitimate investment. They're not all scams, or this is all good or all bad. And if you live by that standard, then you're never going to be able to see value where it might be perfect for you. And I think that's one of the pieces that I want to kind of set the stage for, because we're not coming from a position of bias that's an issue.
And there's a lot of information out there from renowned investors that they've made public in terms of how they've done it, or at least, what they would offer, the common investor to take as a strategy that, they feel over time is going to pan out. And, probably the simplest one we've ever seen has been offered up by Warren Buffett, who we talk about often. He's probably number 2 or 3 on the show in terms of all-time references behind Musk and some of these other mainstream big-time investors. But, this isn't the philosophy he follows inside of his fund, Berkshire Hathaway. But, for anybody who wants to listen, he'll tell you, hey, you want a long-term strategy that's proven to succeed over time? 90% of your money put into a low-cost S&P fund, and 10% into short-term U.S. Treasuries. Simple as that. 2 positions, kind of set it and forget it. If you put your money in that way, give it some time, he's of the opinion that you'll do well, or at least well enough. Now, again, of course, that's not what Berkshire Hathaway is doing, but that's advice he offers to anybody out there. And then there's other strategies that are out there, like an Ivy League endowment. If you take an overlay of what Harvard, Stanford, and Yale and the things that they invest in, what that looks like in kind of a simple snapshot, and again, another time-tested avenue to wealth. I mean, these foundations do incredibly well over time. That looks like a 35% U.S. equity, 28% bond, 15% foreign equities, 11% commodities, and 11% in real estate. So now we're talking about a 5 allocation investment strategy, a five element portfolio that has stood the test of time and gives you a reasonable chance at good long-term returns. And there's other versions like Bill Bernstein's No Brainer. It's simple as this: 25% bonds, 25% European stock, 25% U.S. small cap, and 25% S&P. Again, that's got 4 positions in it. So a lot of the portfolios that you see out there run into, certainly the ones that we pour our effort into and sweat over and try and build with all the diligence that we can, include more elements than that. But there are other avenues to try and find some success as well.
Yeah, and you make it sound so easy. I mean, we'll just use one of those 5 things. We should just call the show over. I mean, why not? Let's
use them all. Why not? Why not just one?
I think the thing is it's easier. It's easier because everyone's like, well, why is it so hard for me to make money in the stock market? Or why does it seem like the stock market's going up and I'm just kind of pedaling along? Or, how does that play in? There's a whole nother conversation, Dan and Seth, that I'm kind of processing in my mind. We've chatted about it briefly. But diversified portfolios and the S&P 500 are night and day, and people in the investment world don't see it that way. They say, "Well, why is my diversified portfolio underperforming the S&P 500?" Well, if you have a moderate risk tolerance, the S&P 500 is highly aggressive. Yeah, it's highly aggressive. The S&P 500 is all stocks. It's 505 stocks, 11 sectors. It is entirely all equities. Therefore, it is highly aggressive. Like any equity would be considered highly aggressive. I mean, Enron used to be considered the staple investment. Oh, goodness gracious. Enron doesn't exist anymore, right? So you really have to understand that when you're buying the S&P 500, and if that's all you own and that's what you're comparing against, don't be naive. That's really not understanding the comparison. And I don't mean to be rude, and I'm not trying to be. What I'm saying is you can't say, hey, the market's doing 20% and my portfolio is doing 10 or 12, and then wonder why when half of your money is sitting in, bonds or something, or a quarter of your money is sitting in bonds not performing well, or you own 20% bonds and you have 20% some euro investment, or Asia investment, and it's not performing, but the S&P 500 is booming. Well, that means only a portion of your portfolio is booming. We show this chart. We do it all the time. Anyone who wants a copy of it, happy to send it to you. It's by MFS. It's a mutual fund company. I just love the chart. I show it to people all the time because it's just so clear what's going on for the last 20 years in the market. But the diversified portfolio is the middle performer of the 10 sectors it's talking about. And it should be. It's meant to be a balanced portfolio. You should be balancing the pros and the cons of everything, where guess what? The top 2 of the 3 performers are all the S&P stuff because they're the highest risk, and they should be. So, that's really a complicated piece because people don't understand diversification and what they should expect from a diversified portfolio.
Well, with that, it's time for us to take a quick break, and there's going to be a ton more when we get back. You're listening to Money on Tap, and you can reach us at 855-226-8551. Don't go anywhere. We'll be right back with Powerhouse Portfolio.
Hello, everyone. This is Dan Mickelon of Brayshaw Financial Group. Are you looking for professional guidance to kickstart your investing journey? Look no further. Brayshaw Financial Advisors are here to help. Our team of experts will provide you personalized advice tailored to your financial goals. Visit us at BrayshawFinancial.com today and schedule your free consultation. Brayshaw Financial, investing made easy.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about Powerhouse, the portfolio powerhouse. And, haven't gotten into much of the meat of the conversation, okay? Because there's a lot that you kind of have to just bring into the basics of it. Stocks, bonds, what is diversification? Let's understand a few simple things here. And in terms of what's going on inside of our portfolios or our designs and concepts, we're going to talk a little bit more in specific. And you know what? There's some things that we can, kind of let the cat out of the bag, so to speak. But then there's other stuff that, that's just the benefit of being a client at Brayshaw Financial Group and using our services, that you get to see what's behind door number 3. And that's just the way it goes. But either way, there's going to be some really interesting concepts and some things that you're going to be able to, kind of take with you and just try to dig a little deeper. With that, let's talk a little bit about, what's behind door number 1 and how did we get here?
I look at it as like a chessboard, and the chessboard and the chess game is different every day, week, month, year, century, etc. What worked 100 years ago as an investment strategy isn't what works today. And I think I create that huge disparity in that conversation, guys. The one thing I love about the two of you guys and Tony is that we all see this world significantly different from an investment strategy than anybody else out there. That's what I love about working with you guys, because we can have conversations about this isn't how the world's going. This is not what we believe to be the best direction for investments. And I love the fact that none of us adhere to some automatic standard of training that exists kind of in these big houses that a lot of people do business with, because that's a low risk conversation, but it might be what I believe and we all believe is a low reward conversation moving forward. And what we're talking about is that demographic shift in the world, like people who made money over the last 40 years, those baby boomers that are super wealthy, they're not investing the same way they did 40 years ago. And we need to acknowledge that as investors, and we need to move with that. It's like dancing. I'm not a dancer. You guys know that. I have no dancing ability whatsoever at all. But that being said, I do know that you're in tandem. You're moving with the motion, and there's this kind of natural flow. If you're moving opposite of the motion, it doesn't look graceful. It doesn't look appealing, and you have to dance with the market a little bit. That's why they have these conversations about momentum, right? Some of these momentum investment strategies and so forth. We have used many different forms of investing, and I'll give you an example. In the last decade, when rates were really low, we made some very intentional plays to get further out of bonds as best we can, contacting clients to move up a risk level. And instead of buying, bonds from big name companies, we bought their stock because their stock was paying a higher dividend yield and might be underperforming the market as a whole and still profitable. That increased our portfolio performance objectively in comparison to itself by replacing that bond holding on some level. And bonds were a drag on that. Since then, rates have risen, as we've all seen. Like, go try to get a house loan or buy a new car. It's going to cost you more to do that. And so since then, we've actually piled in more bonds. And so the chessboard changed. We have a new game to play. And so we're constantly mitigating that. And then on top of it, it's like, well, hey, you know what? Why would we buy a bond paying 5% when we can buy a money market and have liquidity at over 5% right now? And so that game has changed. And so our offerings are constantly evolving. And that's what management and investment management has done. But we've done some other things. Like, I love the fact that we do this stuff, but a lot of people buy these, S&P 500 holdings, is, SPY or IVV or name any number of them out there. And what a lot of people don't know, and we talk about this often, there's 505 stocks in the S&P 500. But that being said, when you go to, any of these different tickers out there and you look at, what they own, and like you say, well, I want to buy the S&P 500. So someone goes out, let's say they buy the SPY, and I'm not encouraging people just to go buy the SPY. It's just one of the companies. But right now, currently, the top 10 holdings are Microsoft, Apple, NVIDIA, Amazon, Google, Meta, Alphabet Inc. as well. Again, their other share class, Berkshire Hathaway, Eli Lilly, and Broadcom. Well, that's actually 32.5% roughly of the entire portfolio allocation. 10 companies out of 505. And a lot of people don't realize that the exposure is so impacted by how those companies move. If we have a tech drop, I mean, most of those companies are all tech. I mean, if tech just completely falls into the tanker, just like the 90s, for those people who remember, you're going to see a massive loss in your portfolio because 32% of your portfolio in that one holding is going to be hammered. If Apple doesn't make a new phone and someone else comes out with a clever new phone, and hey, you know what? They could be slowly dropping like a lead balloon. So these are things you have to watch out for. And we've gone the extra step, the extra effort. What we try to do is we include the S&P 500 holdings in various allocations and tickers that we do, but we also make an intentional allocation to 4 or 5 of the 11 sectors of the S&P 500. So there's 11 sectors. There's, financial, energy, utilities, consumer staples, et cetera. And we'll figure out like, hey, we have a whole method and method to our madness of, hey, these are the top 4 or 5, and we're not going to just invest in an S&P holding. We're actually going to allocate to some of those what we believe to be top sectors when we have an indicator that says, hey, go there. When we don't have that indicator, we're going one place or another, and that might be bonds, or that might be the SPY, or that might be, just a money market. So we really make some intentional efforts, and we've also seen some positive results from that at times. And that's helped, amplify some, areas that are, not necessarily correlated directly with like an SPY or an IVV or an S&P holding kind of allocation. And I think it just gives a whole lot more diversification inside the same index. Now, you could have overlap, and you have to be careful of that, and you have to watch that. And what I mean by overlap is, if of all the ones you buy, you could have a lot of Apple and accidentally get burned. And I think those are the things, those are just a few. I'm going to pass this over to Dan. I don't want to steal all the thunder. But those are some of the things that make us uniquely different, but they're conversations around the same story, which is everyone's looking for larger companies to invest in. And the S&P 500 is the 505 largest U.S. companies out there. But how do you mitigate that risk when it's all stocks?
That it brings me to two things, as we're getting ready for the NBA finals here, and the Celtics are running with the tagline this year, it's different here. And I think Ben's analogy to the game of chess, fits perfectly with this contrast I want to draw between some of what Ben just discussed there with you and those portfolios that we just kind of rattled off that are, designed by, heavyweight investors out there. All of those 4 or 5 that I mentioned leading into this part of the conversation are totally set it and forget it models, right? That was the goal of those designs. We're going to allocate across the board. We're going to buy these handful of positions and just simply ride it. And if you do it yourself investor, maybe that's what makes sense for you because you don't have the wherewithal, the knowledge, or the ability to monitor the markets, find the research, and to make the right picks like we strive to do. But what we're bringing to the table that's different here is that we are actively managing those things. We're going to be in the indexes when we're invested in the market because that's what, history and portfolio design tell us to do. But we're going to take it that extra level of, potentially overlapping and getting a heavier concentration into the sectors that we believe, based on metrics and information that we have, are going to outperform in the next period of time, whether that's a month or a quarter or a year, who knows? The market's going to dictate those conditions to us. It's going to signal to us when we should be in and when we should be out. But what we want to do is maximize that potential return, not by passively riding the index, but by holding those index positions and amplifying where we think the opportunity is best, getting a little extra weight into those sectors that we believe are going to be the best performers for that period.
So it makes sense. Okay. There's a lot of the psychology around investing that makes sense. It really needs to. And just our brains are trying to reconcile, what is this here and what does this mean? And how do I, or do I not, like, participate? And an example of that is just the 401k, right? When we have clients come through that are looking at the 401k and what the options are, most of the time, people will take a look at the funds. And first of all, it's like, well, I have no idea what I'm looking at, usually. And so let me try to get up to speed a little bit. Oh, okay. Well, this fund here did, 11% last year, as an example, right? Or that fund there did, negative 5% over the last 3 years. And the tendency with those things is to start to chase, right? That fear of missing out. Remember that story that we were talking about in GameStop? The investor behavior, what makes sense out of that is people want more. It's like, oh, there's, 20% in this fund. It did, had this return last year. Well, I'm going to go ahead and buy that because the expectation is if that did well before, it's going to do well again. And that's a chasing returns kind of a mentality. So I want to just kind of differentiate. What we're talking about is not that. Okay. Those are observations, and those are in hindsight, and, past performance does not, create a future return. But what we're talking about inside of how we're positioning our investments in the portfolio, especially when we're talking about like the sectors, like Ben, you were talking about sectors. We're talking about using some measurables on that, and performance might be a part of it, but more often than not, we're able to kind of pull out data that shows how much money has been flowing into the sector. Is that favorable? How long has that been happening? At what rate has that been happening? How has that shown up inside of the investment as a return for this period of time? And so looking at that information, understanding historically, how does that fit inside of the story? And what does that offer in terms of a potential, or when do we want to make sure that we're not participating in those? When do they become less favorable? Is not a chasing return mentality here, right? So there's a difference, is what we're trying to make sure that we're on the cusp of understanding how a market works, what's favorable for now. And a lot of people would translate that conversation into momentum. And as you're Googling momentum, it's really fascinating to get into the why and the how of it. And part of what we're understanding in our portfolio is considered a momentum. But I would say, and more on this, we could take a look at 5 different momentum strategies. And 3 of them, as much as they might sound, if that makes sense, they sound like an investable option or something that we would probably want to consider. Their performance has really suffered. And so in the how of it is not just take a rubber stamp, apply it, all right, and you're going to be okay. And the other side of this is the 401k gives us an example of what majority of people are doing inside of investing, which is we're going to go ahead and choose the S&P 500 fund or the glide path fund because they just don't know. And that's one of the things that we're understanding around too. But we want better, right? We want more. So how do we get there? All right, we're getting there. We're going to get there in just a second. We're going to be right back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're going to be back with the Portfolio Powerhouse. Just a minute.
Are you looking for personalized guidance to kickstart your investing journey? Look no further. Brayshaw Financial Group and our planners are here to help. Our team of experts will provide personalized advice tailored to your financial goals. Visit BrayshawFinancial.com today to schedule your free consultation. Brayshaw Financial, investing made easy.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And in this portfolio Powerhouse, okay, we have, kind of covered some of the basics, right? And we've gotten into a little bit more theory with you here in terms of what are we looking at. You know what? This is it's a big part to like really kind of dissect and get into how do these parts and pieces apply, and what are some of the measurables that we could start to use, and how do we apply them inside of the portfolio? Again, such a big conversation for such a short period of time. So we're going to try to do our best to really just get you land the plane a little bit here with you guys.
Seth, landing the plane is a hard one in the stock market right now, but I would say that there's a lot of conversations that need to happen. And one is, we have people call and be like, hey, listen, is the stock market going to pull back? We're at all-time highs. What do you think is going to happen? And so forth. And if you're having that conversation, you're trying to time the market, and that means that your time horizon is not correct with your investment. I think that's one of the big things, so you have to really, kind of narrow in that you have the long-term perspective. Secondly, you need to have a strategy that, has been tested, back tested, has mitigation ability to, further reduce loss or risk, inside your portfolios versus against the market. Those are things that you need to really, figure out how you're going to mitigate, because a lot of our listeners here today they're just riding the wave of the 401k. And so, there's a lot of like buy and hold and set it and forget it. And you hear all these things. And the truth is that get yourself a financial planner. They'll probably help you with your 401k allocations because they can't manage it, or they won't be able to manage it. And get some advice. Most anybody would sit down with you and talk to you about your other investments and your 401k. Find a story, a strategy. Have someone show you, hey, this is how we should allocate and this is what you should do. I think that's the piece that's missing for a lot of people. Like a lot of people who listen to us on the radio, we get calls in all the time. It's wonderful to talk to some of these people. And they're always like, hey, I wish I had called you sooner. I wish I had done something sooner. And so today I would say that if you haven't made a phone call, whether it's to us or to someone else, pick up the phone and do that, because, whether it's, just helping you a little bit and getting you onto the right track, it's about landing the plane for yourself when retirement or the need of that money is coming.
Yeah. And I'd add to that, if this is a different take from what you have heard, if you have met with an advisor and this sounds interesting and this sounds different from the approach that they've attempted to apply in your portfolio, give us a call. You got to come down here and meet with us. With everybody who we present to and sit as a potential client, we'll take a deeper dive on all this information and really show you the method of the madness and why we get results. And I welcome every opportunity to sit with you folks and go through that with you one-on-one.
I love it. Hey, what I want to make sure that you have inside of your story is I want you to have the demographics inside of it. I want you to have the big picture, this wave of finances that is moving through our money system and that you are ahead of and participating in a way that's going to be a big benefit for you. All right. Now, if we can get you the benefit, and that's the goal, it's like we want the benefits without the downside. How are we protected in those downside, or how can we make sure that this money is going to ultimately last for all of our retirement? That's a big part of the portfolio conversation as well. What else do we want? You know what? It gets complex. It gets nitty gritty. And you don't necessarily have to be engaged at every level of that. So let's make it simple. Okay, let's go ahead and apply what we're talking about here to get you the benefits and make sure that your story is one that's a successful story in investing, not one that's just trying to keep up with the Joneses. All right, great. We're glad that we got to have a little bit of a talk on a Powerhouse portfolio and get some of those elements inside of this for you and your story, give us a call at 855-226-8551 or info@yourmoneyontap.com. Oh, hey, if you do that, make sure that you send us your information at info@yourmoneyontap.com so we can get you some of that Money on Tap gear. Love to send that to you guys. Thanks for subscribing. Thanks for being with us today. You've been listening to Money on Tap.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of Osaic Wealth Incorporated. Osaic Wealth Incorporated and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire 03110, and can be reached at toll-free 855-226-8551.
Well, bye.